Welcome to our video on recognizing, preventing, and responding to financial scams. We will cover financial fraud and scams and how to protect yourself. Common financial scams include phishing, where fake messages trick you into sharing personal info, Ponzi schemes promising high returns, identity theft, and romance scams soliciting money through fake relationships. To protect yourself, verify sources before sharing personal information and use strong passwords and multi-factor authentication. Regularly monitor accounts for suspicious activity and avoid sharing personal information on social media. Keeping your financial information secure is crucial. It prevents identity theft and financial loss, maintains good credit and reputation, and offers peace of mind and financial security. If you fall victim to a scam, report the fraud to your bank immediately. Place a fraud alert on your credit reports and report identity theft to the FTC, filing a police report if necessary. Also, monitor your accounts for any additional suspicious activity. Chapter 18 explores the role of entrepreneurship. We'll discuss what it is, the steps to start a business, how to manage finances, and the risks and rewards involved. Entrepreneurship is starting and managing a business for profit. Key aspects include innovation, risk-taking, business ownership, and contributing to economic impact. Basic steps to start a business include idea generation, creating a business plan, legal registration, securing funding, building a team, launching, marketing, and then monitoring and scaling operations. Key financial management for small businesses involves budgeting, managing cash flow, accurate bookkeeping, tax planning, and raising capital. Entrepreneurship involves risks like financial loss, market and operational risk, and work-life balance challenges. Rewards include financial independence, personal fulfillment, flexibility, control, and job creation. Next, we move to understanding inflation. We will explore what inflation is, its effects on your finances, and how you can protect your money. Inflation is the general increase in prices, which reduces purchasing power. Causes include demand pull, cost push, and built-in inflation. Types range from creeping inflation to hyperinflation and stagflation. As inflation rises, the value of money decreases. Higher prices mean consumers need more money for the same goods. Individuals on a fixed income are particularly vulnerable. To protect your savings from inflation, invest in inflation-resistant assets like stocks and real estate. Diversify your investments and save in high-interest accounts. Central banks raise interest rates to control inflation by reducing spending. Higher rates make borrowing expensive, while lower rates stimulate spending but risk increasing inflation. Chapter 20 focuses on the role of government in the economy, covering taxes and spending, public goods and services, economic policies, and the importance of financial literacy. Government generates revenue through taxes like income, sales, and property taxes. This funds mandatory and discretionary spending, leading to wealth redistribution and impacting the economy through jobs and infrastructure. Public goods and services provided by the government for all citizens include national defense, public infrastructure, education, healthcare, environmental protection, and law enforcement. Economic policies involve monetary policy, controlled by central banks to manage interest rates and money supply. Fiscal policy uses government spending and taxation to manage economic cycles, unemployment, and inflation. Financial literacy helps citizens make informed financial decisions, understand taxation and public services, participate in the economy, engage in civic activities, and ultimately reduce economic inequality. This next section explores the future of financial technology, focusing on digital finance and cryptocurrencies. Digital finance uses technology for financial services, including online banking, digital payments, and P2P lending. It promotes financial inclusion and efficient transaction management. Cryptocurrencies are digital currencies using cryptography. Examples include Bitcoin, known for its limited supply, Ethereum, a platform for decentralized applications, Ripple, and stablecoins. Digital currencies offer benefits like decentralization and lower transaction costs, but carry risks such as high volatility, regulatory uncertainty, and security vulnerabilities. They require caution. Digital finance and cryptocurrencies are shaping the future. The integration of digital currencies with traditional finance is rising, with emerging trends like decentralized finance and asset tokenization. Regulatory frameworks will be key. Chapter 22 covers financial responsibility and ethics, defining responsibility, discussing ethical considerations, making informed decisions, and understanding the social impact of your financial choices. Financial responsibility means managing money with current and future needs in mind. This includes budgeting, saving for the future, avoiding excessive debt, and managing risk through insurance. Ethical considerations in finance involve honesty and transparency, responsible credit use, avoiding predatory lending, ethical tax payment, and socially responsible spending and investing. Making informed financial decisions requires research, understanding financial products, evaluating short and long-term impacts, seeking professional advice, assessing risks, and using financial tools like budgeting apps. Financial choices impact society through economic stability. Ethical spending supports fair businesses. Debt defaults tighten credit markets, and decisions can affect wealth inequality and community development. Chapter 23 covers career planning and earning potential, including choosing a path, understanding income sources, planning for growth, and the value of investing in education. Choosing a career path involves assessing your interests and strengths, exploring options, setting goals, networking, and seeking mentorship. Income sources include earned income such as salary, passive income from rentals or side businesses, and portfolio income from investments like stocks and bonds. Planning for career growth means setting clear goals, continuously learning, networking, actively seeking feedback, and being adaptable in your field. Investing in education, including formal degrees and certifications, enhances career opportunities. Ongoing development and learning new technologies are also essential. Chapter 24 covers financial goal setting for life, focusing on setting goals, building healthy habits, regularly reviewing those goals, and tracking your progress. Financial goals can be short-term, such as building an emergency fund. Medium-term goals might be saving for a home down payment. Long-term goals include retirement savings and a child's education fund. Healthy financial habits include budgeting, automating savings, limiting high-interest debt, building an emergency fund of 3 to 6 months' expenses, and consistently living below your means. Regularly review and adjust your financial goals quarterly or annually. Track your progress using tools, adjust goals after major life changes, and consider the impact of inflation and market shifts. Tools for tracking progress include budgeting apps like Mint or YNAB, savings and investment trackers like Personal Capital, debt reduction methods, and goal-setting apps such as Trello. This section introduces filing a tax return. Key steps include collecting financial documents, determining your filing status, claiming deductions and credits, and submitting your return by the April 15th deadline. Thank you for watching this video on financial education.